Hi, I'm Keith McCullough, and welcome to another Real Conversation with one of my favorite guests, Mr. Jim Rickards. Jim, welcome. In the last little while, but first wanted to get your take on this. I mean, is this a repudiation of what the Fed and the fiscal have done in tandem? And I mean economically, not in terms of, people just like navel gaze at the Dow and points. I mean, is what's happening in gold today finally a repudiation that it actually is not working?
Yes, in part. It's a couple things all at once, and we can take them one by one, but that is part of it. I would say that the Fed's monetary policy will fail or is failing, and fiscal policy will fail, is in the process of failing, even if gold didn't exist. If you didn't have gold as a multi-millennial monetary standard, even if gold wasn't there as a reference point, which of course it is, but these policies are failing anyway, and there are a lot of reasons for that. Whenever I hear Fed stimulus or congressional fiscal stimulus, I say, well, no, the Fed can print money all day long and the Congress can spend money all day long, but don't call it stimulus. It's not going to have any stimulative effect. We're way past the Keynesian multiplier, which is now below 1, meaning if you borrow $1 and spend $1, you don't even get $1's worth of GDP. You get some numbers, 70, 80 cents, but forget about the multiplier. It's actually now a divider or something that reduces GDP. Well, you don't get the GDP for the borrowing. And same thing with monetary policy, because unlike Milton Friedman, the monetarists, the neo-Keynesians, the Austrians, and everyone else, money printing has nothing to do with inflation. And they seem to, well, I don't know if they ever knew it, so I can't say they forgot it. So all the money printing and all the deficit spending will not stimulate the economy. And that's true anyway, but gold is signaling that. Gold has... look, all markets try to be forward-leaning. Some do it more successfully than others, more accurately than others, but they try. I would say that, yeah, people say, the stock market is an efficient discounting mechanism for future events, for what they see in the future. And yeah, they look into the future. Here's the forecast. They pick out a discount factor. They present value it and say, here's where stocks should be today, based on where things are going to be, 6 months or a year from now. And that's what they do sort of mathematically and analytically, except they're always wrong about the forecast. You got to get the forecast right if the discounting process is going to mean anything. So markets go through the process, but they always get the future wrong. They're not very good at predictive analytics. So this creates what I call the gap between the perception and the reality. Reality always wins, but not right away. Sometimes it takes a while. Gold, on the other hand, has very high predictive analytic value, number one. Number two, it's more forward-looking. So gold's kind of telling you where things are going to be maybe a year to 18 months from now instead of 6 months from now. So gold is signaling that monetary and fiscal policy will fail and something else will be tried. And that ultimately will result in a much higher price for gold. So gold's just saying, well, let's do it now.
Yeah, I mean, as I think you'd agree, I think you've said so yourself, I'm shorter term than you. I don't think anybody's longer term than you on gold, so that would be easy for me to be, and it's fine. I think that's actually why we get along so well. I learn a lot from you every time we have a discussion. The New Case for Gold, for example, nice shiny book that you guys can all read, was one of the many books that Jim wrote that was just of educational value to me. I mean, if I'm going to have an opinion on something mathematically, Jim, or from within the lens of the cycle, I can have a lot of different opinions on my process and how gold fits in that. And okay, gold started working when real interest rates peaked and started to roll over at the end of 2018. Now it picks up its correlation to the dollar as we devalue it to the downside. As of this morning, for example, this is crazy. I mean, it's happened before in 2011, but it's happening now. Guys show the inverse correlation. This is super short term, right, Jim? I mean, but again, the machine is just chomping on it, forcing Davey Day Trader to buy it. And now we're getting everybody in the pool because it's a 98% 15-day inverse correlation. As you know, the machine likes that 30 to 15-day window. And so it's basically gone ballistic. So now you got both parts, which is every time they fail, I guess if your answer is that both the monetary and the fiscal have failed economically, I'm pretty sure that their only solution to failing is doing more of failing. So that would just perpetuate more down dollar, wouldn't it? And up gold.
That's correct. And so again, you have this. Again, I'm a little more long term. Gold. Look, I've got gold at $15,000 an ounce by 2025. If I'm wrong about that, it'll be sooner and higher. But that's well, I consider that a conservative forecast, and we can maybe take a few minutes to go into the analytics behind that. As I've said before, you've heard me say I don't just throw numbers out there to get attention. I don't really care. I do care about getting the analysis right. There's a number of different techniques, and what's interesting is they all point in the same direction. So it's got to go to 3,000 before it gets to 15,000. It's got to go to 5,000 before it gets to 15,000. So that's my kind of long range forecast. But it could go down tomorrow, and I'm like, I don't get depressed when it goes down. I don't get euphoric when it goes up. I know where it's going in the long run. That's the important thing for if you're trying to preserve wealth and make money. Nothing wrong with making money. I'm all for it. But sometimes preserving wealth is risk aversion is a higher priority than just making a lot of money in the short run. But either way, gold will serve that purpose and and preserve wealth over that time period. Could it go down tomorrow? I guess, yeah. But all the vectors are pointing up very strongly. And I'll give you a concrete example. There are three things that drive the price of gold fundamentally. One that you've already mentioned, which is real interest rates. The lower the real interest rate, the higher the price of gold. Number two, supply and demand. You learn it in your first 3 days in economics, but it still works. And then number three is geopolitical risk. Call it risk off or fear factor, whatever you want to call it, but I think of it in geopolitical space. Those three vectors don't all have to point in the same direction. You could have a situation where geopolitical risk is high, pointing to a higher gold price, but real interest rates are really high, and that would point to a lower gold price, et cetera. But right now, all three of them are flashing green or maybe flashing gold. The real rates are coming down. They're still high, by the way. When I always have to just roll my eyes when really smart people, Dan Isaacson, Bill Gross, Jeff Gundlach, and I admire them all, and I follow them all. But they've all been carried out feet first on this bond bubble thing. The greatest bond bubble in history, and short bonds, and the interest rates have nowhere to go but up. They're just failing to distinguish between nominal rates and real rates. Nominal rates are low. Real rates are not low. Mm-hmm. When I say low, I mean show me negative 4%. That's a low real rate.
That's low.
Well, right. Yeah. So right now, was a 10-year note. I use, you can pick your notes or your bills or whatever, but I usually use the 10-year note rate, 10-year treasury, because it's a good proxy for building, construction, long-term investment. People don't borrow overnight to build a building. They borrow for 7 years if they can, et cetera. So to me, that's my proxy for sort of economic growth and inflation forecasting. That's it's about 70 basis points today, et cetera. But inflation is, 1.5, take your index. So that puts the real rate, maybe negative 25, negative 50 basis points. Well, thank you very much. But, I remind people in 1980, I borrowed money at 13%, but interest rates were, inflation was 15%.
Yeah. And
my borrowings were tax deductible. And the tax rate, I lived in New York City at the time, was 50%. So my real after-tax rate was about negative 7. That's a low real rate. So the point is we have a long way to go. And it doesn't matter, people are interested whether the Fed's going to pursue a negative interest rate policy, take the target rate on Fed funds below zero. Legally, they could. It's already been done in Europe and Switzerland, Japan, and a few other places. I don't necessarily forecast that. I don't think the Fed necessarily wants to go there. But you can have negative yield to maturity on a 10-year note. Just whenever the premium is greater than the present value of the coupons, it's a negative yield to maturity. So you can get there. You can get deeply negative rates in secondary market trading, regardless of what the Fed does, and that will happen. And so in the DV01, dollar value of 1 basis point is higher as the absolute level of rates gets lower. That's just duration, just bond math 101. So we're going to have huge capital gains in 10-year notes as the yield to maturity goes, towards negative 1%. But that's going to be an enormous boost for gold. And we're not even there yet. We're seeing kind of a spike in gold prices when real rates are still, relatively high. They're only mildly negative.
Yeah, I mean, and thank you for giving the framework again. When you go to the top three things that really matter to gold, I think people really need a process. They need a framework. You obviously provide that. On the second, on real rates, I think, again, it's just an exercise on what is your view. Again, if the dollar goes lower and inflation continues higher, then you can get to obviously lower and lower levels on that computation. I think people kind of or should get that one. On the second one, supply and demand, though, Jim, I think that this is where a lot of people, like in the introduction to this book, and I have dog-eared Jim's books, like Death of Money, Aftermath most recently wrote, but again, you wrote Death of Money, then you wrote Currency Wars, then I think in that order you wrote the new bull case for gold. Is that right, Jim?
Yep.
Yeah, so in the introduction, ending the introduction to that book, when you said, when critics say there's not enough gold, what they really mean is that there isn't enough gold at current prices. Can you explain that? That I thought, like, of all the prescient one-liners that you have, and you probably set, Jedi Master Yoda record for those on this topic in particular. What does that mean? Say that in English.
By the way, this just as a very brief aside, the reason I wrote the book was to rebut comments like the one you just read, and I'll give the rebuttal. But I constantly run into people say, well, you can't have a gold standard because there's not enough gold to support commerce. Maybe there was once upon a time, but look at the balance sheets, you can never do it. Or gold output is not high enough to support the growth of GDP on average, et cetera. And every one of those statements I just gave, and many others, are just wrong. They're analytically, empirically, historically wrong. But I got tired of answering the same questions. So I said, I'll just write the book, put it all in one place. And if you ask me, I'll say, go buy this book. But yeah, to your point, Keith, there's always enough gold. There's always enough gold. It's just a question of price. If you say, well, we have 33,000 tons of official gold, that's approximately the number. And if you take it at, well, today, $1,900 an ounce, let's say $1,950, whatever, multiply 33,000 tons by $1,950 per troy ounce, you come up with a number, and that number is far smaller than the volume of dollar transactions in world trade. That's true. That's just a factual statement. So they say gold can't support the commerce. Well, okay, try $15,000 an ounce. In other words, at some price, the same quantity of gold will support a larger money supply. You got to get the price right. And this was one of the greatest economic blunders of the 20th century. In 1925, the UK was trying to get back to the gold standard. They had suspended it to fight World War I. They doubled their money supply, printed lots of money, and that's what you do in a war. It's existential, so go ahead, print the money, and basically enlist the population as unsecured, non-interest-bearing lenders to the war effort. That's what you do. But then after the war, how do you go back? And Churchill had two choices, and he was being advised by John Maynard Keynes at the time. He was Chancellor of the Exchequer in 1925, before he was Prime Minister. They said, look, if you want to set a new parity, you can do one of two things. You can go back to the old parity, which is about $4.86 per ounce prior to World War I. But you're going to have to cut the money supply in half, or keep the money supply where it is and just double the price and make it, 10 pounds per ounce. And Churchill felt honor bound, duty bound to go back to the old price. But they did cut the money supply, and they put the UK in a depression before the rest of the world. And Churchill later said, that was the greatest blunder of my career. I just basically destroyed the UK economy in pursuit of a goal that we couldn't achieve. It seemed like the right thing to do, but it was too late. They had printed the money. So, but the point is, you can have. I'm not saying we're going to have a gold standard. Maybe we'll have some reference to gold or whatever. But whatever you do, if you're going to tie the money supply to it, or discretionary monetary policy to the price of gold, you got to get the price right. And that number is about $15,000 an ounce, under one set of assumptions. Could be higher, but certainly not lower.
Mm-hmm. So we have our real rates view. We have our supply and demand view, geopolitical point, and this is the one that's really been moving most recently. Obviously, you've written about this extensively way before it started to happen, or as it was happening. I think it is the way that we would, as bean counters, would have noticed that. China, Russia, hoarding of gold. Again, you've said that they're just not going to give it back. I mean, does the U.S. I mean, I think that you and I agree that there's probably a greater chance that I grow to 6'1" in the next 5 years than the Fed adopting a gold standard. But at the same time, can't you just have one de facto, because of what China and Russia, et cetera, are doing as the dollar goes lower. Could that just?
Well,
yeah,
okay, the answer is yes, Keith. And by the way, I always tell people, you don't have to wait for the Fed or the U.S. Treasury. You can go on a personal gold standard. Just take your dollars and go out and buy some gold. It's legal. It didn't used to be, by the way. Yeah. Gold was contraband until 1974, but it's perfectly legal. And just go on your own gold standard. But to that point, the Fed and the Treasury working together. But let's just take the Fed because it's a standalone entity. How do they conduct monetary policy today, or even just targeting the Fed funds rate? Well, they do it through open market operations. So they go out and they buy Treasury bills, short-term bills, and they increase the money supply and reduce the supply of bills if they want the rate to go higher, or they sell Treasury bills if they want the rate to go lower, and they sell Treasury bills and reduce the money supply if they want the rate to go higher. You could do the same thing with gold. There's nothing stopping the Fed from buying and selling gold as an open market operation. And in fact, I advised them a number of times that that's exactly what they should do. What's the difference between gold and a 10-year note or a 30-day bill in that situation? You can increase or decrease the money supply and target the price of gold at the same time. So, for example, if you said $5,000 an ounce is our target price, you're a buyer at $47.75 and a seller at $50.25, and use the gold in Fort Knox and West Point and the printing press to achieve that target. You can do that. And the question is, why would you do that? The greatest problem the economy is facing today is deflation. I mean, everyone on Wall Street is running around, inflation, the hair's on fire. There's no inflation. Try finding it. There is disinflation. I saw an economic report this morning from a very reputable service. No need to mention names, but one of the top services. And they said that they were talking about the reporting from Australia, and they said that inflation, forget the exact word, but inflation was negative. That was it. And I said, well, there's a name for that. It's called deflation. But they didn't want to use the D word. So they're like, inflation was negative. It's like, well, okay, well, it's called deflation, guys. Look it up. But that's where we're heading. And this is the Fed's worst nightmare for two reasons. Well, several reasons. Number one, you can't tax it. Like, in other words, if your pay stays the same, everybody wants a raise, right? But let's say your boss says, get out of here, I'm not giving you a raise. You're lucky I don't fire you. That's kind of where we are today. If your pay stays the same, but the cost of living, but prices go down, your quality, your standard of living just went up because you get more stuff for the same amount of money. But the government doesn't know how to tax it. Now, if there's inflation and your boss gives you a raise, you might be no further ahead in real terms, but they can tax that raise. But they do tax the raise, but they haven't figured out how to tax deflation. So the government hates it because people's standard of living goes up, but they don't know how to tax it. But more to the point, it increases the real value of debt. See, inflation, deflation are really important concepts. We watch them. They affect markets. They affect real rates. They affect gold. But debt is a funny thing. It's nominal. If I borrow $1 million from you and give you a note, I owe you $1 million plus interest. Now, it's interesting if the real value of that goes up or down based on inflation or deflation, but either way, I still owe you $1 million. But if we have deflation, the real value of that debt goes up a lot more than just the interest accrual, obviously. So we're over indebted. The debt to GDP ratio is by the way heading to 130%. It was 105% when Trump took office. He bumped it up to 106%. It was going up, but all of a sudden you spend $5 trillion in 1 year, you don't have, boom, and lower the GDP. So lower GDP, increase the debt. Debt to GDP ratio is 130%. We're catching up with places like Greece, Lebanon, and Italy, but that's bad enough, and that's a drag on growth, by the way, which is why fiscal policy doesn't work. But if the real value of that debt went even higher, then you would have the kind of dollar crisis, loss of confidence, super spike in gold prices that you're talking about. Well, what happens in deflation? The real value of the debt goes up. And so the Fed has to avoid deflation at all costs. And furthermore, if when deflation hits and the real value of debt goes up, superficially that's bad for debtors and good for creditors because the real value of their asset went up. And that's true right up until the date of default. And when the debtor says, hey, I'm out of here, here are the keys, you take it over, you deal with it, right? So at that point, it falls on the banks And then the banks are in distress, and who bails out the banks? The Fed. So this all ends up in the Fed's lap, whether it's the Treasury not being able to afford the debt because of lack of growth, or banks going under because they end up owning all the assets and can't collect. So they have to have inflation, but they don't know how to do it. I mean, the Fed has been trying to get inflation for 12 years. 12 years. And it's a sad day when a central bank wants inflation and can't get it, but they barely hit their 2%. They use a core PC deflator year over year. Fine, whatever, pick your metric. But their target is 2%. They've only hit it for a few months in the last 12 years.
Right.
They can't do it. I can do it in 15 minutes. But I can. So I've been to the boardroom at the Fed. So you go in the room, you close the door, you have a meeting. It doesn't even have to be on the schedule, and you vote to conduct open market operations in gold with a target price of $5,000. And Jay Powell walks out to the microphone and says, my fellow citizens, price of gold is now $5,000. If you think that's cheap, we'll come and get it. We'll sell it to you. If you think that's expensive, show up, we'll buy it from you, but we're going to basically target that price. And why would you do that? Not to enrich gold holders, it might, but that's not the reason. The reason is that nothing happens in isolation. The world of $5,000 gold is the world of $400 oil, $100 silver, and basically the price of everything goes up. That's how you get inflation in 15 minutes. It's been done successfully by two presidents in the 20th century. FDR did it in 1933, 1934 on purpose. He knew what he was doing. Richard Nixon did it by accident between 1971 and then finally super blow off in 1980. Nixon wasn't president then, but he set the thing in motion. So they prove you can do it, but the Fed forgot how, and so they're going to keep printing money, messing around with the yield curve, doing everything they're doing. None of it is stimulus. None of it will cause inflation, but a higher target price for gold will.
Yeah, I think a lot of people, like whenever we talk about this, inflation versus deflation, which again, in one of your many, I guess, reducing this to like the blue team, the red team. I think you called it the blue team, the red team the first time that I read, the way that you thought about inflation versus deflation. The way I've thought about it is you have secular deflation, it's long term, it's obvious, and you have
right.
cyclical spurts or episodic clusters, as Mandelbrot would call them, of inflation off deflated prices. And,
right.
and in fractal math, as you know, in any nonlinear system, it's the particular thing that happens at the particular time, within the particular cycle. And
right.
at this particular time, we have the most amount of people with no job and or about to lose their job, the particular lowest level of corporate profits that would support new jobs, and a particular inflation when everybody's sitting at home, trying to feed their families and pay for their medical costs at
right.
precisely the wrong time.
Right.
So I wonder what your response is to that, if you agree with that or not.
Well, I was declarative when I said printing money does not cause inflation, and it doesn't. Again, I'll just use the last 12 years as Exhibit A. We should probably relate to the viewers what does cause inflation. And the answer is velocity, the turnover of money, the lending and the spending. But the problem is velocity is a psychological phenomenon. The Fed can stick the landing on money supply. They can get it down to a couple decimal places if they want. But if you want to control velocity, which is the key, that's psychological. So what you have to do is change the psychology. Well, what is the psychology right now? It's deflationary. The savings rate in May was 33%. It had been going up. It kind of made its way like from 4% to 7%, but then it spikes to 33%. Well, savings is a good thing. You can drive an economy if you can convert savings into investment. And furthermore, if the investment is productive, unlike what China's doing. But we got some infrastructure or some other projects, R&D that would be productive. That can drive an economy. You don't have to drive an economy on consumption. You can drive an economy on productive investment. But the problem is twofold. Number one, it has a much longer time frame. That's a 5-7 year time frame. And it comes, in the short run at least, at the expense of consumption. So our economy is driven 70% by consumption. If you substitute savings for consumption, you're killing velocity. Because if I put my money in the bank and leave it there, the velocity is zero. And I remind people, $5 trillion or $6 trillion times zero is zero. If you can print all the money you want, but if you don't have velocity, you don't have an economy. And so the question is, how do you change the psychology. How do you get and by the way, it makes sense to say if you're unemployed, you better be saving because you're maybe lucky if you can pay the rent. But even people who are working or still have their jobs, they're worried, maybe I'm next. Maybe they fired the guy down the hall, but maybe I'm next, and maybe I better save more just in case, and so forth. So that's not a bad thing. I'm not saying that doesn't make sense. That makes a lot of sense, but understand what it means. It's deflationary. It reduces velocity. It offsets the increase in the money supply, and it's very hard to get out of. I mean, Keynes called it a liquidity trap, and he was right. That's what it is. So how do you change the psychology? Well, you need something big. You need something dramatic that's going to get people to say, wait a second, what's going on here? Well, one of them would be a $5,000 price for gold.
Mm-hmm. 5,000. I mean, that'd be great. I think that'd be, again, it would be great for us. Unfortunately, it'd be not great at all. It'd be devastating to many people that have no effing clue on how to get invested alongside that. I mean, you really do have, and that's always been, if you go back to Henry Hazlitt, if he was having this conversation with you in the 1960s, it was pretty clear to Americans back then, that these are the realities of your life. This is how the currency works. This is how the purchasing power of your hardworking dollar works. These things, they've basically been eliminated from the narrative. You wrote a great note the other day called "Don't Fight the Narrative," I think, and a lot of it's become narratives. They're political narratives. There are obviously a lot of different kinds of narratives. They don't all have to be accurate, but I mean, the narrative really, I wonder, and you have also written about that lately as well, saying, okay, look, now I think Trump may not have the chances that I thought that he had before, and understanding that it's all within the same language that we speak, which is rising and falling probability. What opportunity narrative-wise is there for a politician who, God forbid, actually understands even a tenth of what we've talked about in terms of, okay, I'm devaluing the dollar, I'm going to create a triple-digit debt to deficit or debt to GDP ratio, double-digit debt, the highest ratios you've ever seen. And by the way, that's bad for you, the people that work hard for these dollars, that don't have a job, and now your cost of living is going to go up right before the election.
Right. Well, I mean, if you have 2% interest rates, the Fed can cap interest rates. By the way, I don't care where the market wants to go. If they want to, they did this in World War II through the Korean War under the Treasury Fed understanding, which eventually was torn up. But that did last, in the war years and after. But if the Fed wants to cap interest rates, 2.5%, and you can get inflation to 4%, let's just say 2% on the 10-year note, 4% inflation, that cuts the value of the dollar in half in 17 years.
Wow.
17 years is not that long. And from the time your kids are born to the time they go to college, the dollar has lost half its value in real space. That's how you deal with the debt. That's how you that's how you get the debt to GDP ratio under control. And by the way, we did this once. The last time the debt to GDP ratio was as high as it is today was at the end of World War II. But again, as with Churchill in World War I, you do what you have to do to win the war. I don't quibble with monetary policy during World War II. But everybody knew that the Fed and the Treasury and the White House knew that you had to get that under control. Well, they did. The debt to GDP ratio went from about 120% in 1945 to 30% when Ronald Reagan was sworn in. 30% is completely manageable. 60%, you're living large, and 90% is you cross the threshold, according to Reinhardt and Rogoff, where you can't borrow your way out of slow growth anymore. You're actually it's a headwind to growth. 120%, good luck, but 30% is manageable. But they got it from 120% to 30%. And what struck me, I did the history of this in my book Aftermath, Chapter 2. But what struck me about it was a bipartisan effort. You had Democrats, Harry Truman, John Kennedy, Lyndon Johnson, and Jimmy Carter, and you had Republicans, Dwight Eisenhower, Richard Nixon, and Gerald Ford, working together. It was never a partisan issue. It was like, hey, this is what we have to do, and then it's gone up ever since. So from 30% in 1980, it's on its way to 130% today. But so the question is, how did they do that from 1945 to 1980, that 35-year period? How did they do it? Well, the answer is they just ran inflation a little bit hot, slightly higher than interest rates, and it's just like watching an ice cube melt in your hand. The debt goes away.
Mm-hmm. This, man, you're like you're encyclopedic. So again, Aftermath, Chapter 2, beginning of Chapter 2. if you've done all of your Jim Rickards work, you can get there and you can see that Jim uses a fantastic quote. Again, it's amazing to me, Jim, that these things have existed for hundreds and hundreds of years. But you open that chapter, which you call Putting Out Fire with Gasoline, with an excellent quote by David Hume. We have always found where a government has mortgaged all of its revenues that it necessarily sinks into a state of languor, inactivity, and impotence. Now, that, again, it's not like you just wrote this book yesterday. I mean, you actually most of your books are actually on time, where most books are written procyclically after something happens. But isn't that the most blazingly obvious thing, where you don't have to have a sophisticate on the old wall or one of these linear econs running around at the Fed that actually kind of understands this? Because David Hume taught people that a long time ago.
Well, that's right. By the way, I play a little game with my my editor at Penguin Random House. We have a great working relationship, but we call it Hidden Treasure. I put things in the book and I make her find them. But the title of that chapter, Putting Out Fire with Gasoline, is a line from a David Bowie song, and the title Aftermath was, I think, the Rolling Stones' 5th album. So it's meaningful in context, but I try to enlighten it, or liven it up a little bit. But yeah, the David Hume quote is correct. It is pertinent, but you have to say, well, why did David Hume say that? Why did he think that you didn't always run debt to the max? By the way, I'll give you the answer in a second, but this is the one of the main rebuttals to modern monetary theory, which I cover in chapter 5 of the same book.
Yep.
And the answer is, because Stephanie Kelton says, well, why can't we have a debt to GDP ratio of 200%, 300% like Japan? Borrowing and spending is not a constraint on child care for all, Green New Deal, free education, Medicare for all those things. Just spend the money, borrow it. If the market gets balky, the Fed can print the money and monetize the debt. We take the GDP ratio up to 230. What's the problem? And by the way, when it was presented to me that way, and that is the way MMT people, modern monetary theory people, present it, it took me a while to formulate the rebuttal, because I thought to myself, well, what is the problem? I mean, it's all legal. The Fed has no constraints on its balance sheet. You got the debt ceiling, but they kind of roll over on that. And the Fed can either force the banks or monetize the debt itself. So what is the problem? And there are a number of answers to that. But one of the problems, and what David Hume was pointing out, is the reason you run up the debt is to fight a war. And the reason you take it back down again in times of peace is to prepare for the next one. And so what I do in chapter 2, I go through the cycle. The debt to GDP ratio had gone up many times, but it always came down. So Mexican-American War, Civil War, Spanish-American War, World War I, it went up, but in times of peace, during Reconstruction or, the first decade of the 20th century, et cetera, they took it back down again to get ready. So it's like dry powder. It's no different than, why do we store cruise missiles and ammunition, et cetera, if we're not fighting a war? Well, the answer is we might be in a war tomorrow, and it would be good to have those things. So one of the reasons you leave some headroom, as Christine Lagarde would call it, but between your actual debt level and your potential debt level, so that you can use it in an emergency if you have to, and that emergency is usually a time of war, although it's not exclusively war. That FDR did this in the Great Depression. I think most people would agree that the economics says that during the Great Depression was tantamount to a war. And by the way, we're in one today. We're in a war on a virus. But you keep that dry powder, if you will. So there are other objections to MMT. We don't have to get into them all. But that's the big, and that's what David Hume was talking about in the context of the Napoleonic Wars and basically the history of England or the UK. So you want that cushion, you want that space, so that you can use it in an emergency if you have to break the glass and run up the debt for other reasons.
By the way, if you're game for it, I'd love to host a debate. I'll be the moderator. I'll just kind of take I'm just kind of like this passive guy, so I'll just sit back and watch. But a debate between you and Stephanie Kelton would be fantastic. She won't. By the way, if you can organize it, you're the man. And actually, if anyone can do it, probably you can. By the way, I've met her. Nicest lady in the world, very bright,
personally very, very congenial. We couldn't be more different on the subject of modern monetary theory, but she is the bright light. There are a number, Warren Mosler, very successful hedge fund manager, I'm sure you know, is in. I've spoken to Paul McCulley about it. He's not in, he supports it basically, thinks it's interesting. So she's not the only one, but she's the leading light. She has a new book on it, and I would love to debate her. I think it would be a fun debate, but I have a graduate degree in economics, but I don't have the PhDs. So I think the PhDs don't like to debate non-PhDs. So you're not in their club, but I'll do it if you can organize it and invite her. She's got a book out, so I don't know why you wouldn't do.
I think I can get her to do it. I think she likes me.
Yeah.
I mean, she likes me. It's just like it's on Twitter. I could see it. She quite likes the Twitter thing too. Obviously, she's building some momentum, and I'm going to review her book on Hedgeye TV with her. So I'm going to warm up the bus here, Jim, and I'm going to go for it. I'm going to try to get.
Okay, well,
I'll try to.
Give me 15 minutes notice, but sign me up. I would. Again, very nice lady, smart. It would be. I think it would be a good debate. I always say in these debates the viewers win.
Yeah, 100% agree on that. Now back to the and if you have questions for Jim, fire 'em in the queue. That queue is hot and heavy right now in terms of upvotes, downvotes, everything else. But back to that point you made on war. Now again, I want to just how do you think Xi is thinking about this moment? He obviously doesn't think in terms of like, what do I do by November of 2020? He's playing at least the 2025 game where they think they're going to overcome the U.S. from a GDP perspective. They like to have the IMF be housed in China because that's kind of the thing. The biggest country gets to house the IMF. There's a whole bunch of strategy to consider if he's playing a gigantic game of Go while we're playing checkers politically, and we're very short-term and myopic about it. But again, isn't there a war that just started between China and the U.S., but call it cyber, economic? It doesn't have to be the kind of war that people think of. You've written extensively about all kinds of wars on this front. And if I were to be the rising power, to kind of, I guess, exercise that Thucydides trap book, and I'm China, if there was a time to attack the U.S. at its weakest point, it's right now.
Right. Well, people refer to the Thucydides trap in reference to a rising China and a established superpower of the United States. And it's a great book, by the way. And read the original. Thucydides had a lot to say. But I always remind people that Sparta won. In other words, it was not Athens was the rising power. Sparta was the established power, and Sparta won the Peloponnesian War. So don't count out the United States. I'm not saying you were doing that, but just a reminder to people who to make that reference. But China is incredibly weak. They are putting on a pretty good show. They have ambitions. Maybe eventually they'd like to take over the world, but they'd be pretty happy taking over everything from Central Asia to Hawaii, and Australia to the North Pole. In the meantime, they're working on that. And again, it's not just So the points, the flashpoints are obvious. It's Taiwan Straits, and the South China Sea. But we got a new one in the Himalayas. Try fighting at 14,000 feet. I've been there. It's kind of hard to move fast, but they're killing Indians on that border. And the Indians killed a lot of Chinese too. That was a tough fight. So why is and now they're the latest thing is they've expanded the membership of the Asian Investment Infrastructure Bank to I think over 100 members. The U.S. is not a member, but pretty much everyone else has signed on. That is housed in China. Xi gave a speech just 2 days ago, was saying, this is this institution is the model for the future, the model for development. Everybody's welcome, etc. So whether it's militarily, diplomatically, financially, they are pushing as hard as they can in all directions to shove the United States out of the Western Pacific or East Asia, and basically become a global hegemon. Now they will fail, but it doesn't mean that there won't be some serious confrontations and possibly even a shooting war in the meantime, which again is another reason to keep the debt under control in case we need that borrowing power. When you say the war started, the war started either 10 or 20 years ago, take your pick. You can say it started in 2001 when China became a member of the World Trade Organization, or in 2010 when they, kind of launched the currency wars were worldwide. and the U.S. was part of it, but China, severely devalued the currency to promote their exports, and they're doing that again now that the yuan has been back and forth. But again, just in the last 24 hours, I have pretty good sourcing on China. They're setting up an internal payment system in case we kick them out of SWIFT. It's the global hard currency payment system. It doesn't seem likely in the short run, but we could do it. That's like cutting off the oxygen supply to a patient in ICU. And so China's preparing for that. So the fact that they're even thinking about it. And by the way, I'll give you one, Keith, and this to me is very real. I'm used to getting laughed at, so it's been happening for a long time. But this is one I take seriously, and I think people should give some thought to. China is responsible for the global coronavirus outbreak. Now, by the way, I just wrote a book on this. When you're 9 years old and you show up in first grade or fourth grade or whatever, and your teacher says, okay, class, I want you to write an essay on what did you do this summer, and everyone's got to write their little essay. If people said, Jim, what did you do during the lockdown? Well, I wrote 2 books, but one of them is on the pandemic and the Great Depression, and it deals with where the virus came from. Obviously started in Wuhan, but was it from a wet market and what's called zoonotic transmission from an animal to a human, or did it leak from a laboratory? We don't know for sure, but the weight of evidence, and there is a lot of evidence at this point, is that it came from a laboratory. I'm not saying it was a bioweapon. I'm not saying it was leaked intentionally. It was probably accidental, could have come out of a Petri dish, but it came from that lab and spread around the world. At a minimum, China's handling of it, once it became apparent, was criminally negligent at best, and I would say probably a crime against humanity. So we are where we are. The U.S. has the most cases, the most fatalities, the greatest economic damage, measured in the trillions, 4 trillion, 5 trillion, take your pick. It's something of that order of magnitude. So what if you commence a lawsuit, and by the way, some lawsuits have already been filed, where you name Chinese institutions, and official bodies, et cetera, cite them for criminal negligence, seek damages. And what if you win? And you do this in U.S. courts, by the way. You could get a $4 trillion judgment against China, and then people say, well, yeah, what does China care? They'll say, good luck collecting, pal. Well, guess what? They have $1.4 trillion of U.S. Treasury notes. The last paper Treasury note, I think, was printed in 1980. Those things are 100% digital, have been for decades. That digital ledger is run by the Treasury and the Fed. And you could have a situation where a judge could order that 1.4 trillion, convert it to a trust or a conservator for the benefit of the plaintiffs in that lawsuit that I just described. And people say, oh, you could never do that. You'd ruin the bond market. No, you wouldn't. There'd be a rally because you would reduce the floating supply by 1.4 trillion. So the demand for the remaining notes would be even greater. There would be total due process of law. It would not be an arbitrary or capricious confiscation. We can do that too, but you wouldn't need that. It would be all due process of law, and Chinese 1.4 trillion would be converted from their ownership to a trustee for the benefit of victims. Now, if you're China, I always say, if I can think of it, the Chinese can think of it. I mean, I just did. I just described you how it works. But I'm assuming this is open to the public, right? The Chinese are probably streaming it. So the point is they've thought of it too. So what would you do if you were China and you thought your 1.4 trillion was in jeopardy along the lines I just described? One thing you do is buy gold, and maybe get euros, but they're not too hard to track down either. But one of the things you would do is buy gold, because if it's physical and you have it in your own vaults, then you actually can't get your hands on it.
Now that should have made everybody think. Okay, just think about that. That's and as we're all thinking here, I'll just jump into the questions here, Jim, because there are plenty of them, and I know that you can do the rapid fire. The one of the most votes, I think it's because this gentleman thinks that we disagree, so that's a good one. Jim, can you explain why you believe deflation will occur first in the economy before inflation, and why Keith may be wrong in thinking inflation will occur first?
Well, either one could happen. It depends on policy, but I expect deflation to occur first and be very hard to dig out of unless you go with the gold open market operations that I described. But deflation was the state of the world before the pandemic, and it's driven by what I call the 3 Ds: demographics, debt, and default. And so the demographic trend. By the way, if you want to come up with a ton of explanatory power, Keith. The United Nations publishes a population series, basically world population growth, and it's hard to do annually, but they're kind of like updated every 5 years. Have a look at the UN time series and world population growth from, pick a starting point, 1950 through 1995. Population keeps going up; it's not going down. But the growth rate fell off a cliff in 1995. So look at the second derivative of population growth. Boom. Well, guess when velocity peaked? 1998. And guess when the Fed, the first deflation scare, 2001. Why did Greenspan keep rates too low too long, which he did? He was worried about deflation. He never came out and said it, but that was his concern. And so this is the Chinese population, thank you, one-child policy. They now have the most rapidly aging population in the world, maybe second to Japan, but their workforce is, not unlike the baby boomers. They're reaching retirement age or dying out, and they don't have the replacement workers. Everyone's coming off the farm, going to the cities, has already made that trip. The manufacturing, super high export generation is getting close to retirement, and they don't have the replacements. So, and actually the whole world population is declining in Russia. It's declining in Japan. I had an interesting conversation with, Saki Kabara. He was assistant finance minister in the 80s. He was known as Mr. Yen. You probably knew him as Mr. Yen. And I said, Saki Kabara-san, your debt to GDP ratio is 230% and your GDP is going down. How does that work? I said, well, what you're missing is the population is going down faster. So on a per capita basis, we look pretty good. And I thought about that. I said, well, you're right, mathematically. So the logical extension of that is Japan ends up as a country with one citizen who's the richest person in the world because he owns the whole country. but the point is, he's right on a per capita basis. But what does it mean? Where does economic growth come from? I mean, you can do a 4-part, 5-part definition of GDP, but it really comes down to labor force and productivity. If you want to just do the simplest version of that math, how many people are working? How productive are they? Well, productivity has been going down for reasons that are not entirely understood, and the labor force has been going down. Labor force participation has been going down. So that's a recipe for declining GDP. So that's deflationary in and of itself. Debt we already talked about, and of course the other one is technology. So there's a natural deflationary trend anyway, which the Fed was fighting with money printing, and it was kind of a standoff. Why did we not get more inflation from the money printing? Or why did we not get more deflation from the factors I just described? Well, the answer was they were kind of equilibrating. But you can understand monetary policy is a desperate race to print money faster than velocity is declining, because if you don't, then your GDP is going down. Here comes the pandemic, and you shut down the whole U.S. economy, basically shut down. And by the way, I have a whole chapter in my book on the lockdown. The 100-day, the chronicle of 100 days, I call it. But it'll be viewed as the greatest blunder in economic history. The old 90-10 rule. You could have got 90% of the benefit of the lockdown from an epidemiological point of view at 10% of the cost. Yep. Yeah. Hand washing, sure. Mask, fine. Social distancing, fine. No big sporting event. A lot of those things were smart, and they're still smart, but you didn't have to shut down every nail salon, every pizza parlor, every dry cleaner, every barbershop, every bar, every restaurant. You didn't have to do that, and we did, and we've destroyed the economy. But that now adds to the deflationary vectors. So we're going to get the deflation. We're seeing a lot of signs of it already, but then I also explain why the Fed can't tolerate deflation. So you're having a situation of deflation that the Fed finds intolerable. How do they get out of it? That's the policy question. They don't know the answer unless they're watching this video. But I just told you the answer, which is you do what FDR did, which is you raise the price of gold, and everything else goes up. By the way, FDR knew he was going to do it. It was the greatest example of front running in the history of finance. He bought up all the gold at $20 and once he had it, he raised the price to $35, and the Treasury kept the delta. The Treasury kept the profit, which was used to finance the Exchange Stabilization Fund, which Rubin used to bail out Mexico in 1994. So it all goes around. But the point is, Nixon did it by accident, and we blundered into hyperinflation. In 1977, Jimmy Carter issued U.S. Treasury bonds denominated in Swiss francs. Because nobody wanted dollars. They were those were called Carter bonds. But that's how low confidence was in the dollar that we issued Swiss franc bonds. So that was by accident, a blunder. But FDR did it on purpose. But his reason was not to enrich gold holders. And again, he pocketed the profits. It was to get the price of everything else up. It was to get out of deflation. It was to break the back of the Great Depression. And it worked. We had another severe technical recession in 37, 38, and that's why the Great Depression is typically dated to 1940. But 1933 to 1936 was high growth. 33 was one of the best years in the history of the stock market. But the problem was you were going from 25% unemployment to 14% unemployment. Well, that's really good progress, but it's still 14% unemployment. So people didn't feel better. But Roosevelt knew what he was doing, and you could do it again, but the Fed doesn't understand. Maybe Judy Shelton can give voice to this. I'm kind of, we may have to get along without Mitt Romney and Susan Collins, but I'm optimistic she'll be confirmed to the Fed board.
Well, I guess just that question's popularity shows the opportunity to educate. I mean, for me, for example, I don't think anybody was screaming deflation louder than me from the point that mattered. If you go to slide 15, when headline inflation peaked in Q3 of 2018. That's why we bought treasuries. That's why we bought gold, because real rates peaked in conjunction with just a cyclical inflation. You get cyclical, right. And by the way, we don't even need to get into the bullshit that is CPI. The thing's been changed, the calculation, like 9 times since 1996, because the government, of course, would never say that there's any cyclical inflation either. Then we get, the question says, you believe that deflation will occur first. We've been saying that for going back to Q3 of 2018, and then we ended up with a negative oil price. I think that's actually top 3 all-time deflations. Epic panic by the Fed. A cyclical inflation is something that can last 3, 6, or 9 months. I'm going to trade it because my job's to make money. I'm not going to theorize on that. But if you just look at slide 17, guys, it's a predictive tracking algorithm. We run it against a commodity price sample basket, things that are inflating in dollars. It's a trivial. The answer to my question on that, on inflation, is a trade. It's not the secular trend, which again, the trend is demographic and debt and everything that Jim just went through. Are we on the same page on that, Chip?
Yeah, absolutely. And again, it's just a question of time frame, shorter term, longer term. Yeah. And of course, your data is completely accurate. Although I do point out that CPI is an average, and averages, it is what it is. But averages hide more than they reveal. Yeah. Because I'll say there's no inflation, and it went up a little bit, and there was a trade there. I get that, but there really is not much inflation, and we're heading to disinflation, probably deflation. But then someone will say, well, what about the price of pork? And, okay, fine, the price of pork went up, price of steak went up, but what about tuitions, which are going down? What about technology, which is going down, clothing, textiles going down. So you can pick a spot, and my mother's almost 90, still does her own shopping, but she'll complain about the price of milk. I say, you're right, Mom, but there's a lot of other stuff that's going down, but it's not the average, it's the degree distribution. Mm-hmm. And what's interesting about inflation metrics is that there's a very wide degree distribution. Like, in other words, if you had 2% inflation by some measure, and 100 components were clustered around 2%, that would be pretty powerful. That's kind of interesting, but it's not. It's like there's some stuff that's going way up and there's stuff that's going way down, but the stuff that's going down is starting to dominate.
Yeah, and it's also the particular for a certain component of the distribution. if you look at if you should look at a distribution curve of people with incomes or none at this point, that's actually my point, which is slide 75, guys. And this is, you said this too, food at home and medical costs, which last I checked are for a low income or no income earning family. No income is probably the most important cohort or distribution of human beings. That's pain, right? It's pain from nothingness. The black line on food was absolutely no inflation, nothing, forever. And then at particularly the wrong time, when they all lose their job, we decide to take that basket of whatever they have left in savings, which is nothing. 50% of Americans have less than $1,000, or that's what they had prior to the checks. Correct. That's a problem. That's a major problem. That's why Wall Street's living large in our neighborhoods. You've written about this too. Westport, Connecticut, and where you're at too. These are like now just booms in terms of the rich have the income, they have the mobility of income, and the people with no money are going to get screwed.
Right. Yeah, and now this is kind of beyond the scope, Keith, but you're right. You're touching on income inequality, income distribution. These are severe social problems. But you're right. Even the average prices or sorry, these particular prices are distributed all over the place, so they're not clustered around the average. But when you get to the spender, the consumer,
Yeah.
that's also a wide degree of distribution. That's not clustered around any average.
Yeah, that's actually, this isn't in the queue, but I have to ask you this question. I mean, does this end? I mean, we've already had riots in this country, and it's hard to really pin down, if you think about Neil Howe's The Fourth Turning generationally, how much is really in that as opposed to the particular thing that the media is like narrowcasting on. But do you think that this ends in? I had a PM, he's got to be in the top 5% performing, long onlys actually. So he's long gold miners, tech, and some healthcare stocks that have been high flyers. And he said, hey, look, man, if I keep making money for these reasons, there are going to be riots. He actually told me he doesn't want to make money anymore. Like, if he keeps making money, then there's a higher probability of riots in this country because it widens the inequality gap. What do you think about that?
Well, one of the books you're holding in your hand, Keith, is Aftermath. And if you turn to the conclusion, and by the way, that book came out in July 2019, so it's
right.
A year old. In that, you'll see the word pandemic guaranteed in the next 3 years. So my forecast was between 2019 and 2022. Happened in 2020, but it mentions pandemic. And you'll see reference to social disorder and armed gangs and militias on the streets. They're in the book I wrote a year ago. So I just finished a new book. It's coming out October, at the end of October. And it's pandemic and Great Depression. But there's a whole chapter on the mental health implications and behavioral implications of what we're going through. And when I started writing this book, I said, okay, this is going to be the first book on the pandemic. You can't do a book in less time than I did, with a lot of help from my publisher and my editors. It was a team effort. But they said to me, Jim, you can do this book, but you got to write it in 6 weeks. And I said, okay. I usually take 2 years, but I said, I'll do it. And I did write it in 6 weeks. And we're getting it out as fast as we can. But so when you research your book, you're like, well, okay, what research should I be doing? And there hadn't been a pandemic like this that anyone had written about since the Spanish flu. So I said, well, I'm going to read about the Spanish flu because that's my baseline for understanding what's going on. And what's interesting about that is that was 102 years ago. All of the really good books on it, almost all of them have been written in the last 20 years. Beginning with John Barry's The Great Influenza. But why were people not writing about it in the 20s and the 30s and the 40s? There's a long explanation for that, and part of which is it was so shocking they couldn't deal with it, they couldn't process it, particularly coming on top of the casualties from World War I. And they were contemporaneous, by the way. The worst part of the Spanish flu happened during World War I, during the last 6 months of World War I. So it was almost like too many people were dying, too many different ways. But one of the one of the things that came out of that in terms of what we're going through now were the mental health aspects, which, the flu was a horrible death, and you could get viral or bacterial pneumonia and, incredible pain. And it was in some cases were mild, but the bad ones were really bad, and 100 million people died. But if you were a survivor, or even if you of the flu, or even if you didn't get it and you survived in that sense, the mental health toll was enormous. And there have been psychological studies about this, and why did artists not talk about it, and who did, and how did it impact John Steinbeck and all that, and a lot of good medicine and good clinical studies on that. So bringing that forward to COVID-19, one of the underreported aspects, although I think we're seeing it behaviorally, is the toll. Like, it's if you get a bad case, it's a horrible disease, and the fatalities are tragic. But the lockdown, cabin fever is kind of a cliche, but it's not a cliche. It's a serious problem. People are meant to be social. When you cut off the social contact, they become anxious, they become angry, they become depressed. Yeah. Suicides are up, alcohol abuse up, drug use up, domestic violence up, etc. And so this whole George Floyd thing, those guys are, one of them's under arrest facing second-degree murder charges. The system will take its course. And that act, I can't draw a straight line from the pandemic to the death of George Floyd. Let's just say that we know what happened. But the outpouring, the riots, what turned into riots, the demonstration, again, Antifa has been waiting in the wings. This was their moment. But the 750 cities under siege at one point all over the world. Most of it peaceful, not all of it by any means. In my view, there is strong linkage between that response function and the antisocial conditioning rise in anxiety and depression from COVID. So, and this is going to be, the effects of this, Keith, are going to be intergenerational.
Yeah, I mean, it's a tough one to kind of, you have to have a lot of knowledge and have to have read all the cycles of history to come up with the answer that you just gave, so thank you for that. But, there are people who are poor, they don't have a job or they have one and they're poor. And then there are people that have poor mental health. I mean, those things combine, like you said, you just don't. And that's actually, again, presciently in chapter 5, you start with a quote by my man JC, Jesus Christ. I'm an Irish Catholic. I hope it's okay with everybody. Hope you don't cancel. But the poor you will always have with you, and whenever you wish, you can do good to them. And and that's an amazing quote. I mean, it always will be. But I mean, for times like this, again, I think it's quite humbling for people to actually think about that. If you've made a lot of money during this pandemic, that's great. If you have lost a bunch, I guess, whatever too. I mean, there's a real struggle there, and I think that you'd be remiss to think that just went away because the Fed waved some magic wand. I have to ask one more question because we're running out of time, and this question's been asked different ways, Jim. But it has to do with end of the U.S. dollar, basically. JR, are the U.S. these days numbered as the world's reserve currency, et cetera, et cetera? We have a lot of different ways that people have asked that. Is it ending? Is it the beginning of the end? How do you think about that?
Well, I spent a lot of time in Washington, and I hate to admit it, but I was a registered lobbyist and spent a lot of time on the Hill and working, one-on-one with the members. One of the first things I learned in Washington is you can't beat something with nothing. No matter how much you dislike something, no matter how much you badger it, beat it up, trash it, etc., you can't get rid of it unless you have something to replace it. So, is there a potential for a very rapid, complete collapse of confidence in the dollar? Yes, that potential is there, but it won't come into play unless there's something to replace the dollar. Now let's think about what that is. It's not going to be the euro or the yen, and there's all the major currencies, major reserve currencies. Swiss franc, Aussie dollar, Canadian dollar, have slices, sterling, etc. They're all but they're like passengers in a lifeboat. And they don't have much food and water in the middle of the ocean, but they're in the same lifeboat. So you can go around and say, well, this guy's a little taller or she's a little smarter or whatever, but they're in the same boat. They're going to sink or swim together. So you're not going to have a world where suddenly people are dumping the dollar. Hey, get me those euros. I can't wait. Because the euro and the dollar, the cross rate, they're in this together. And forget the yuan. There's no secret plan to make the yuan the global reserve currency. I could give you it would take 15 minutes to list all the reasons why that won't happen. But you can't. By the way, a reserve currency is not a reserve currency in isolation. It's not like you have a whole bunch of dollars on pallets in the basement of your central bank. It's a numeraire. It's the way you denominate the assets you invest in. What you need are not dollars. You need dollar-denominated assets, primarily U.S. Treasuries. But the point is, you can't have a reserve currency unless you have a bond market, because you need something to invest in. Well, what do you need for a bond market? Well, why don't we start with the rule of law? You don't have that in China or Russia. You need repos. You need forwards. You need when-issue trading. You need primary dealers. You need a clearance system. You need so much stuff that took us, by the way, decades to evolve, and it's still evolving, that there's nothing close to replacing the dollar among fiat currencies. So what are the two candidates? Well, there are only two. One is gold, and I'm not forecasting a gold standard. I am forecasting much higher gold prices. But if you want to go back to a gold standard, like a real one, and I talked to Paul Volcker about this, and he concurred, you're talking $15,000, $20,000 an ounce. You can do it, but that's the implied non-deflationary price based on gold supply and money supply. But that's where you have to go if you want to do that. If you want to use gold as a reference, okay, but again, you're going to need some kind of open market operations. The other candidate is the special drawing right, the SDR, and this is what China has its sights on. China knows the yuan's not ready and won't be ready, but the SDR is sort of extraterritorial. They're printed by the IMF. So how would you make the SDR the global reserve currency. Well, the first thing you would do is increase your voice inside the IMF, which is exactly what China's doing. They take things. Chinese take things from the inside out. They're like termites. How did they take over the World Health Organization? From the inside out, by getting the leadership. It's how are they stealing intellectual property from U.S. universities? Getting their graduate students and their professors. A lot of whom are being led away in handcuffs these days because Trump's finally pushing back on this stuff, et cetera. So worm your way into the IMF, get a larger voice, and recruit some allies, and then promote the SDR. Now, where it gets really interesting is, and it'll all be digital. I think Bitcoin and stuff like that are junk, but it doesn't mean you can't have a digital cryptocurrency if it's the SDR. I always say the dollar is the most successful digital cryptocurrency ever because what you have in your wallet and papers is trivial compared to the digital dollar. But would you have a digital gold-backed SDR?
Yeah.
Or an SDR anchored to gold, because the IMF actually has 2,000 tons of gold. They don't like to advertise that, but they do, and they could acquire more. And by the way, SDRs can be printed at will, subject to executive board approval in the IMF, and they don't. The distribution is not limited to the member countries. Again, I'm enough of a geek. I've actually read the Articles of Association. They can give SDRs to multilateral organizations such as the United Nations. So we have a world where there's sort of a gold link digital SDR printed, handed to the United Nations to finance a global climate change agenda. Yeah, that's not a stretch. So that's what you have to look out for. But what I tell the Treasury when they ask, the Treasury and other government agencies in Washington, they're very nice to me. I always get the meetings. They always hear me out. They're very polite, and they never do what I suggest. But that's okay. At least they talk. But in addition to the Fed running open market operations in gold as a way to beat deflation, I just say, look, why aren't you buying more gold? Screw the Chinese. Why don't we go buy 2,000 tons? Good luck to them trying to find some. Of course, you'll run up the price, but we can print dollars, right? So, and you're getting, it's a twofer. So we print dollars, buy gold. We drive up the price of gold, so we leave the Chinese in the dust because they don't have the dollars to keep up with us. And meanwhile, we get some inflation, which is what we want.
Yeah.
So what's not to like?
I mean, if they're going to buy junk bonds, if they're going to buy, gold, we're not even talking about the same thing, obviously. I didn't want to, put it there. But anything and everything should be on the table from that perspective. And
right.
And you've talked a lot about this over the years, too. And I think that, you've opened people's mind in terms of like how to actually think about all of it while being polarized by not one specific part of it. I think so many people politically, need that, almost like a release. If they just turn off the TV, not us. We're obviously having a great conversation, but just turn off the noise and read Jim's books. You're at least start with a base pack of knowledge, and then on to Jim's next book. So I'm really excited to read the next one, Jim. That's great that you wrote. You said you wrote 2 in 6 weeks or 1?
Well, 2. The other one is on Lebanon.
Okay.
I doubt that will be a bestseller, but maybe the Mossad and the Iranians will read it. But I did write 2 books. The one that the one's called the New Great Depression: Winners and Losers in a Post-Pandemic World.
Okay.
That's the title. We'll have the it's done. We just final editing. We'll have the Amazon page up probably next week, and it'll be in the bookstores and available, delivered by Amazon October 27th. And that'll be in Kindle, audio, and hardcover. So that's the book to the world. The one on Lebanon was a specialty number, but kind of interesting to me. That may be a canary in the coal mine also.
Yeah, that's what looking at the world fractally means. You have to look at everything to understand that particular thing. So thanks for that. I'd love to have, by the way, this aftermath. You gave me the uncorrected proof for limited distribution. I like to get my early look-see at the.
You'll have the galleys are the real collector's items, because we only print maybe 200 versus 100,000 on the books. So hang on to those, but you're on the galley list for the new book. Absolutely.
Well, I appreciate it, because I would vote myself number 1 in dog-earing Jim's books. I don't have a PhD. I did have the lowest SAT score in my class at Yale, so I do have to do hardcore studying. So I think I'm one of if you call me one of Jim's fanboys, I'm totally cool with that. I think you have a lot of them, fanboys, fangirls, everything, fully loaded. So thanks for spending the time, and I'm going to try to get you that debate with Stephanie Kelton.
I'm up for it. Thanks, Keith.
All right, thanks, man. He's Jim Rickards, the one and only. And again, I highly encourage you to educate yourself with all of his content. And again, thanks for joining us.